Guys, do you think your crypto is safe from taxes? Think again. Whether it's worthless stocks, staking rewards, airdrops, cryptocurrency received as gift or inheritance, or mining income, the IRS still wants its cut. But how do you report these, and can you avoid overpaying? Stay tuned as we break down the tax rules you need to know before tax season hits. Today, let's talk about all these, step by step. First things first, what exactly qualifies as worthless? How to report worthless crypto and stocks on your taxes according to IRS guidelines. For the IRS, something is considered worthless if it has no value by the end of the tax year. This means you can't sell it or trade it for anything of value. Alright, now that we know what qualifies, let's dive into the steps on how to report this as a loss. Step 1. Gather all your documentation. This includes any transaction records, purchase receipts, and the statements showing that your asset is now worthless. Next, you're going to want to fill out Form 8949. This is where you report sales and other dispositions of capital assets. List the worthless crypto or stock under Part 1 for short-term holdings or Part 2 for long-term holdings. Enter the name of the asset, and for the sales price, enter 0. For the cost basis, you'll put in what you originally paid. Then, you'll need to carry over this information to Schedule D, which summarizes your capital gains and losses. The loss will offset any gains you have, and if your losses exceed your gains, you can deduct up to $3,000 from your ordinary income for the year. One thing to remember, you can carry over any remaining losses to future years. So if you have a big loss, it won't go to waste. And that's it. Reporting worthless crypto and stocks might seem daunting, but with the right steps, you can easily navigate through it. Stay smart, stay invested, and keep your finances in check. Now, let's talk about another aspect of crypto that you need to be aware of: staking rewards. Staking is a process where you participate in a blockchain network by locking up your tokens to support its operations, and in return, you receive additional tokens as rewards. But how do you report these staking rewards on your taxes? First, you need to know that the IRS considers staking rewards as taxable income. The fair market value of the tokens at the time you receive them needs to be reported as ordinary income. This means you need to keep meticulous records of the date you received the rewards and their value at that time. This value will be subject to income tax. Alright, so you've reported the staking rewards as income. What happens when you decide to sell these staked tokens? Here's where capital gains or losses come into play. When you sell the tokens, you need to determine the difference between the sale price and the fair market value at the time you received the staking rewards. This difference will be your capital gain or loss. For example, if you received staking rewards worth $100 and later sold them for $150, you would have a capital gain of $50. Conversely, if you sold them for $80, you would have a capital loss of $20. These gains and losses should be reported on Form 8949 and then carried over to Schedule D, just like we discussed for worthless crypto and stocks. Reporting staking rewards might seem complicated, but with careful record keeping and an understanding of the tax implications, you can stay compliant and avoid any surprises come tax season. Now let's move on to another common scenario in the crypto world: airdrops. Airdrops are free distributions of cryptocurrency tokens or coins, usually for promotional purposes. But even though they're free, you still need to report them to the IRS. So how do you do that? To report airdrops on your taxes, you need to include the fair market value of the tokens at the time you receive them as ordinary income. This value should be reported on your tax return, and it will be subject to income tax. Make sure to keep records of the date and value of the airdrop for accurate reporting. This documentation will be crucial for your tax filing and will help you avoid any potential issues with the IRS. If you later decide to sell the airdrop tokens, you'll need to report any capital gains or losses based on the difference between the sale price and the fair market value at the time of the airdrop. Essentially, the value at the time of the airdrop becomes your cost basis for future transactions. So remember, while airdrops might feel like free money, they come with their own set of tax implications. Stay diligent with your records and reporting to ensure you're compliant and avoid any unexpected tax bills. Guys, another important topic in the world of cryptocurrency and taxes: Reporting cryptocurrency gifts and inheritances. Receiving cryptocurrency as a gift or inheritance might seem straightforward, but it comes with specific tax considerations. When you receive cryptocurrency as a gift, you don't need to report it as income at the time of receipt. However, you should document the fair market value of the cryptocurrency at the time you received it, as this will be crucial for calculating any potential capital gains tax when you decide to sell the gifted crypto. For example, if you receive one Bitcoin as a gift when its market value is $10,000 and later sell it for $15,000, you'll need to report a capital gain of $5,000. The cost basis for the gifted cryptocurrency is the fair market value at the time it was gifted to you. In the case of an inheritance, the fair market value of the cryptocurrency at the time of the decedent's death becomes your cost basis. So, if you inherit one Bitcoin valued at $10,000 at the time of the decedent's death and later sell it for $15,000, you would report a capital gain of $5,000. It's essential to keep detailed records of the fair market value at the time of receipt, whether it's a gift or inheritance, to ensure accurate reporting and compliance with IRS guidelines. Additionally, understanding these details can help you plan your investments and avoid any unexpected tax liabilities. Now, let's delve into another critical aspect of cryptocurrency and taxes: mining. Mining cryptocurrency can be a lucrative venture, but it also comes with its own set of tax obligations. When you mine cryptocurrency, the fair market value of the coins at the time you receive them is considered taxable income. This means you need to report this value as part of your gross income on your tax return. Additionally, if you later sell the mined coins, you'll need to report any capital gains or losses based on the difference between the sale price and the fair market value at the time of mining. It's important to keep detailed records of your mining activities, including the date and value of the mined coins, to ensure accurate reporting and compliance with IRS guidelines. Remember, staying informed and diligent with your records can help you avoid any unexpected tax issues. Got any more questions about crypto and taxes? Drop them in the comments below. Don't forget to like, subscribe, and hit that notification bell for more tips on managing your investments. See you next time.